Hello, YouTube family, bulls and bears. My name is Jason, and it's Friday, January 7th, 2022. You may be watching this on Saturday. I'm actually putting this out pretty late on Friday night, but I spent a good part of today researching and getting some nice articles, some nice information to go over with you here today. For example, when I was driving, I listened to at least two interviews, and we're going to talk about some news that I found in those interviews and look at some charts and analysis and give you a lot of good information. So please stay tuned. Let's go ahead and get started right here. With more bad economic news hitting today, December jobs numbers, only 199,000 jobs added. That was less than half of what was expected. They expected 422,000 jobs, only 199,000 jobs added, but yet the unemployment rate fell to 3.9%. So the bad news continues. Technically, the markets really should have been deeper in the red today, with all the major indexes down slightly. With today having the Russell 2000, the only index that was down more than 1%. Now, it's pretty interesting that we added less than 200,000 jobs for the entire month of December. When you look at the previous month, the number of people that quit their jobs in November was 4.5 million. And this large number of people quitting their jobs is being called the Great Resignation. Well, because of the labor shortage, a lot of these people are quitting their jobs to move on to what they consider better jobs, or maybe easier or less stressful jobs. I would like to think that everyone's moving on to a better paying job, but it's really hard to tell because people are just getting further into debt. Even if people are getting better paying jobs, a lot of times it's not better enough to keep up with the rising cost of living. So you see debt still increasing for most people. If you're someone that's out of debt right now, consider yourself very, very lucky, or maybe it was skill, maybe it was good decision making on your part, but it's getting harder and harder and harder to stay out of debt. All right, now let's talk about the Fed. Now, first of all, we know that the economic growth that we have seen over the past several years has been a result of massive money printing, stimulus, rescue programs, forgiveness programs, continuous bank bailouts, bank support, corporations being supported with bailouts, the buyer and lender of last resort, the Fed, purchasing tons of corporate debt. We went into all the numbers here on this channel many times. Is the Fed's been buying at least $100 billion worth of assets each and every month, over $1 trillion a year. Now they're talking about winding down those purchases to zero by March. Again, we'll have to see how it plays out. There could be some real bad news that comes out, and the Fed could say, oh, we've changed our mind, we have to reverse course. The economy is no longer recovering. Anything can happen, but expect to see some changes in the economy if the Fed does follow through on what they're saying they're going to do. Now, let's take a look at interest rates. This is very interesting because mortgage rates are rising. And we're looking at a one-year chart here, and this shows us the 30-year fixed mortgage. If we look at the black line, that is the Mortgage News Daily number, and it's right along with the Mortgage Bankers Association, or the MBA number. And as we can see here, we're up near 3.3%, a little over 3.3%, and pretty soon we're going to be at a one-year high if we break 3.45. It's going to be very interesting to keep an eye on this. Now remember, the Fed has control of mortgage rates with their operations, or via their operations, as far as purchasing assets and securities. The multi-decade lows that we've seen here in mortgage rates and interest rates, it's just not something that's happening by accident. That's not just some coincidence. It is the result of the money printers, the Fed, and their actions. So they have not allowed rates to rise. And we've asked the question here over many years, if the economy is doing so good, why don't they just have or allow higher interest rates? Why can't people get some money? Why can't people get a return on their deposits in a savings account or a CD? Why does it have to be a fraction of 1%? 1% if you're lucky. Well, the answer to that is the banks, they don't need your money. When they can get endless amounts of money that's just digitized, when they can get endless digital notes pushed into the bank, pushed into their coffers, they do not need your deposits in order to loan out money. And that's the big problem with our current financial system is we have endless amounts of money that can be created out of thin air, loaned out, but it's actually not money. It's just digits on a screen, but yet they're going to charge you interest on it and make you pay it back with interest attached. That's why we have this tremendous debt problem, because you can just print endless amounts of money. That's why we're seeing this inflation take off and skyrocket like very few people had expected, except for us on this channel. We knew this was happening. We're keeping an eye on the Fed's action, so we'll tell you where it's going to be headed here. But it's very interesting what's happening with the mortgage rates. We'll keep you updated on that as we see more progression. Will the Fed go ahead and allow markets to crash or correct via their actions? Here's a recent article. Fed officials see earlier rate hikes as U.S. hiring recovers. Well, with less than 200,000 jobs added, is the Fed actually going to pretend that that was good news when it was less than half of what was expected? Or will the Fed at some point to a statistic and they'll say, oh, look at this month's job numbers. We now can no longer raise interest rates. We're going to have to start buying securities once again so the banks can loan out more money. And we'll take all of these risky loans off the books of the banks. That way they can continue to loan out money for assets that are already in bubble territory. Do you see how this works? I think most of you do. So the banks have to keep out loaning larger and larger amounts of money. They have to leverage higher and higher and higher in order to keep this bubble inflated. As soon as they pull back on the lending, as soon as the guidelines are tightened against the banks, then this bubble goes pop. So a lot of us here think the bubble's going to pop at some point, and it's divided. A lot of people also think the Fed's not going to stop, and we're going to see never-ending rising prices, which is also very dangerous. A deflationary correction is dangerous. A lot of jobs are lost very quickly. Just look at all the real estate agents that vanished after the housing bubble went bust about 12 years ago now. Actually, 2008, end of 2008, closer to 13 years. A lot of agents, real estate agents, lost their job just like that when the market corrected. So corrections are more fierce and they're faster, downward corrections, I should say. But they get the pain done more quickly versus an inflationary collapse where your purchasing power collapses. In my opinion, that's much more dangerous. It's much less noticeable, though, because it doesn't happen as quickly. It happens over time. So we're going to see how they continue to, if they continue to inflate the bubble, or if they're really going to pull back and allow a deflation, maybe even a major correction. That's why I strongly urge you to have some assets that will inflate if they continue inflating, but also have some cash on the side, because if we see a deflationary event, you're going to be glad you had some purchasing power when things come down, when prices come down, home prices, stocks, whatever it is you like to invest in. Precious metals may even come down. We're going to talk about that in our next report, how are precious metals going to react if there's a market drop or market correction. Well, I think you'll like the answer if you're in metals right now. So we'll talk about that next episode. Thanks for being here. Stay well, stay safe, keep stacking. Bye for now. Big love. Peace.